It's been a tremendously volatile week in the market, from the Boston tragedy to gold sell-off to Dow earnings. Here to put it all in perspective is Alec Young. He's from S&P Capital IQ. Welcome, Alec.
Nice to be here.
All right, so before we get into some individual earnings, tell me, we've seen some volatility this week. Should we expect this to last during the entire summer? Should we sell in May and go away? What should we be doing right here?
Well, I think it's an interesting time because obviously year to date, stocks have done nothing but go higher. But what we've seen is a few triggers that have people questioning the strength of the global recovery in the last couple of weeks. And so we've seen some profit taking kick in, and we're kind of at an interesting inflection point. A lot of people aren't sure. They understand why stocks have come down. There's definitely more risk out there in the US and abroad. Earnings haven't been great, but people are wondering, is this just a pause, or are we going to see something more meaningful that, as you said, lasts several months? I think right now the jury is still out. One thing that we're doing is taking more of a defensive focus when it comes to sectors as a way to keep a foot in the market but also minimize risk.
Let's talk about some of those earnings. IBM came out yesterday, stock sold off. They missed by a nickel. They said some weak sales, especially as regards to Japan, where the weekend really hurt them.
Right. So taking it up a little bit from IBM to the broader tech sector, that's an area that's really struggling. We're seeing parts of tech that have more to do with the cloud and the internet doing great. But by the same token, we've got anything PC related, hardware related. That was the weak spot for IBM, really struggling. So as a result, because there are still so many legacy companies in the S&P 500 tech sector that are very PC centric, and we all know who those are, even though other companies like a Google or are doing very well, the sector overall is underperforming, and I think IBM's miss just kind of reinforces that.
We also saw GE come out with results. They beat on the top and the bottom line. However, Jeff Immelt says that Europe is worrisome.
Right, and again there, a big bellwether echoing a broader theme. We all knew that Europe was in a mild recession coming into the year, but what's changed is people are pushing out the timing of the recovery. People had thought by the summer things would be getting better. Now it's more like a fourth quarter story. For the full year, growth down about 0.5% in Europe. Should be up a similar amount next year, but I think investors are getting antsy. They want to see evidence that, yeah, sure, the sovereign situation's calmed down, but is growth really coming back? So far that's been elusive, and that's another factor that's weighing on the market right now.
And then McDonald's said sales fell year over year. They're having problems in China. Tell me what's going on at McDonald's.
Well, I mean, bringing it up to a higher level, because our analysts are the experts on the individual stocks. But what's happening in China is they printed 7.4% growth in the third quarter of last year. It rebounded to 7.9 in Q4. People thought, okay, we've got the soft landing, things are bouncing back. Well, it was 7.7 in Q1, we found out on Monday, but that was less than the 8% that Wall Street expected. So you still have jitters about the magnitude of the slowdown in China. Sure, 7.7 is a great number by any standard, but it is moving in the wrong direction. That has people nervous. I think McDonald's comments just kind of reinforce that already negative macro perception.
And let's bring it all back here. We see China slowing. They're not eating as many hamburgers. GE is not selling as much in Europe. We have problems in Japan. That's why they're weakening the yen. What's going to happen in America?
Well, what we've seen here is the U.S. has been the best house on the bad block, but even the momentum in our numbers, if you look at the leading economic indicators yesterday, if you look at the March payroll numbers, the momentum is definitely slowing. I would call it a stall. So we're growing about 2%. For a while, people thought we might be able to do better than that this year. I think those expectations are coming down. We do, though, have a Fed that's being very accommodative. And what that's doing, it's not doing such a great job at jumpstarting our sluggish growth, but what it is doing is it's convincing yield-starved baby boomers to buy high-quality, lower-beta defensive stocks. And that's an area that we would continue to focus on.
Thanks a lot.
My pleasure.
And thank you for watching The Street.